This is Justin Pulitzer. This is a special video presentation, market profile, a basic look, normal distribution, poor high, and poor low. So on the stream, I often say that I'm seeing poor highs or poor lows, and people are like, what the heck are you talking about? And this video seeks to answer their question. So assume that this is a normal day's worth of trade of a completed auction, so to speak. You have all the makings of it. You have excess to the highs, where price spent very little time, but you had a shoot up and a probe of price to the highs. The same thing to the bottom, that it didn't spend a lot of time there, but you had a probe of price to the lows. And then the fairest price to do business, where most of trade took place. This would be a normal bell distribution, so to speak, except it's tilted on the side to reflect price and time. Now, when I talk about having poor highs, it just means that this tail here is snipped off, that you did not have excess in terms of a probe of price is higher, meaning you had the test of the lows, excess to the lows, the bulk of the time spent in the middle, and you just did not have that completion of the tail to the upside. The same thing could be said to the poor low, which just means you had your excess to the upside, the bulk of prices took place in the middle, and you just did not have a completion of the bell to the lower part. Now, this makes a lot of sense to me because I deal with this all day long, but I'm going to bring it to you guys in real-term trade with regard to the S&P, E-minis, and Facebook. So we had a poor low. This was actually from this past Friday. You can see price came down off of a liquidation break, often what happens from a poor high, and you were trying to get prices lower. This was sellers who were pushing. They couldn't get rewarded with still lower prices. You had the back off bounce, came back down, again couldn't find initiative sellers to bring price still lower, backed off again a little bit more. They tried it one more time. You could see these multiple bangs, and when you can't get initiative sellers to reward you with still lower prices, you get a back off here. This is the opposite of a liquidation break. It's like a re-liquefaction rally, a short covering, a squeeze, if you will. So this still leaves the poor low, meaning that there was no excess to the auction to the downside. The opposite here is the poor high, which happened in Facebook. This is sort of like a P formation, which is what I talk about when it's a short covering or short squeeze, so to speak. And you can see you move straight up. You form the flag, you back off because you can't find new buyers to take it still higher. You come up again reject a little bit, the same thing again, come back, but still forming higher lows, came back up, and finally we got the repair to the upside, and it formed the spike in price to complete the auction, if you will, so to speak, to the upside. So these are two examples of what I would say are a classic textbook of poor lows, the squeeze, and then in this case the repair off of to complete a poor high. Typically when this happens, you wind up having the back off, and then you then subsequently have the completion to the downside. That is typical for a poor low. The same thing with a poor high. You often can repair it and then sometimes have a liquidation break like this back to the downside. So that are poor highs and poor lows. And I hope that answered everybody's questions. If you still have more, please leave a comment. If you like this video, be sure to give it a thumbs up and like it. Please be sure to follow me on Twitter. My handle is @JustinPulitzer. I film these videos every week, and I look forward to speaking with you in the future. Cheers.